Welcome back to the Raw Selection Private Equity Podcast. Where on earth did 2024 go? Merry Christmas, Happy New Year. I hope 2024 was a phenomenal year. It was a down year. Q4 was much better for private equity firms. But 2025, let's hope that this is a real cracker for each and every one of you. So today on the podcast, we have Richard Neff, a proven operator and operating partner with private equity and private equity-backed companies, discussing today the investor and operator relationship and his learnings from his huge amount of time in his career with GE. Let's dive in. Richard, if you can share a brief insight into you, please.
Yeah, sure. So I'm a career services executive, mainly in healthcare, business tech-enabled services, and industrial services, both at corporate America, but I was very fortunate to work and get involved in businesses around the world. I actually lived in 3 countries over 10 years, but 25 years with GE, both at GE Capital and GE Healthcare, and then the last 9 years in private equity, both lower middle market and middle market private equity in the U.S.
Perfect. What's one mistake that you see either private equity firms or portfolio companies making, and what would you suggest to correct them?
Yeah, I'd preface that I think private equity firms actually do a lot of things well, and sometimes they get a bad rap. And I've been, as I said, I've worked in the corporate world. I've seen a whole range of private equity businesses. I do think they create value in terms of creating jobs and creating vitality in businesses and industries and competitiveness, which are positives. I think sometimes they're overly ambitious. Many of the firms that I've worked with put together what's called a value map, and you can call it whatever it is, but they lay out the things that they're going to potentially do with that company, and hopefully there's an alignment with the company around that. But often those are 4, 5, 6 items. They're going to launch new products, expand distribution, hire a new sales leader. And you go, wow, this is a $20 million company. And so I think at a macro level, it's great to be ambitious, but being focused is usually more successful, even if there are successive big things that you want to do. Like pick one, do that, and pick the next and do that, and so on, versus trying to lay out and in some cases, burden a small business with expectations that might not be realistic.
So if we look at that small business side of things, what do you think the main focus? I mean, every business is going to be different, but from the businesses you've worked on, I'm sure private equity firms have got their big, what terminally coined as value creation plan and all the things they want to change the rule book. What have you typically focused on when you've gone into, let's say, 20 million revenue business? Take a look at that. What's moved the needle the most in your experience?
Yeah, and this may sound cliche, but I'll say it. I think the 2 biggest levers, besides financial investment that can help enable things in the business, whether that's doing M&A or investing in new sales distribution. The 2 biggest challenges or aspirations of businesses that align with private equity are around human capital and investing in their team to have the capability to go to the next level. If that's whether they need more talent or they need more experienced talent, or fill in the blank on that. So the human capital side, and the other is on the growth side, and that's a pretty broad spectrum. Meaning it could be investing in new products, it could be investing in new sales, it could be investing in new adjacencies, and again, they're typically businesses that if they've aligned thoughtfully with private equity, that there's a mutual agreement that this business would like to do more and has the capability to do more. And the private equity team can be a facilitator and enabler of that. Particularly if you get into certain firms that are PE firms that specialize in certain verticals or certain industry sectors.
Perfect. And with that relationship between private equity investor and private equity executive or portfolio executive, what do you think private equity investors can do to better align themselves, better understand obviously the role of the executive, rather than just going, here's what we think for the value creation plan, here we've agreed it, why have you not done it?
Yeah, I think there's a little, this is probably a little bit of a macro view. We can take any industry, but honing in on private equity, there's often, I don't want to say not an appreciation, but maybe a misunderstanding between those who are the evaluators and those are the doers. And I think the private equity firms are just like any investment bank analyst type community. They're terrific evaluators on opportunities in spaces. That's their job, to find unrealized opportunities in spaces, and then to invest in those, to bring value there. Pick any subsector, but then doing the work. I don't mean PE firms can be unappreciative, but it's just kind of human nature to say, well, yeah, just go fix this thing, or just grow this business, and what it really takes to do that. Particularly in a company that, even though there's diligence and a lot of effort put into over a multi-month period to say understand the business, no one ever really knows what it's like to run a business until you walk the halls, virtually or figuratively, walk the halls of that business and what its capabilities are. And so I think that's sometimes the disconnect. Now that isn't always the disconnect, but frequently, you can think of an analog in buying a house or something. Yeah, you kind of do your diligence and hope for the best, but until you live in the house for a couple of weeks, you don't really know what you bought. And I think sometimes there's a surprise there around, wow, we thought this business was more capable or further along, or whatever that is. And and the net effect of that is, if there's a 5-year plan or a 6-year plan around the value creation, the first year, I'd say maybe 50% or more of the investments I've run, the first year ends up being infrastructure and catching up on things that the collective, the PE collective, thought was in place prior to the investment. So it's not necessarily wrong. It's just surprising that it's always a surprise. I guess it's like, for firms that have done this over and over, you say, well, wouldn't we anticipate that we may have to do a little more infrastructure work to pave the way for what our combined agenda is? So
you said infrastructure work, so let's dive into that. So most people would consider that finances need improving, and both the closing of books and the running of all of the finance function is typically improved immediately from a private equity perspective. What are some of the other infrastructure elements that you kind of think that private equity firms kind of think are there, but realistically they're probably not?
Yeah, and infrastructure, meaning, just to align with you, I think around capabilities. What are the core capabilities in that business? Usually the core capabilities that the PE firm and the investor group think are in place around a sector, those are usually there, meaning that the company has some good value prop in some or multiple segments within wherever they play. And so those are not so often missed, but but the depth maybe, or the capability behind that, is often missed around, let's say there's a sales team of 10 people, but 2 people are carrying the whole load. And so there needs to be an upgrade there. But I'm agreeing with you on financials, but just kind of going into other areas. Or say that, their aspiration is to launch 2 new products in the next year, but they've got 1 product guy, or so sometimes the smaller companies are threaded around a few individuals who are the knowledge brokers or the few capable people. So sometimes it's a capability and depth issue, and sometimes it's actually a build out to say, yes, we want to go into a new adjacency with this company, and we've got to go hire a whole sales team and staff that, and then these people have to ramp up, and that could take a year. And so that's not necessarily, again, wrong. It's just saying, it's not like we just say we want to go into this new adjacency and that happens in 3 months.
To protect investors from bad hires for your portfolio company, I've collated into a brand new book some of the top tips and processes investors use to ensure they do not hire those bad hires into their portfolio companies. We are giving the book for free for the first 100 people that join the waiting list. So please check out the show notes and get your name down for a free copy. So you spent a considerable amount of time at GE Capital, which you kind of described to me before we hit play hit record, to go on air, as kind of very private equity led. So GE Capital was a big animal, obviously isn't so much anymore. Tell us a bit about your experience there. Tell us a bit about some of your learning, because I was working for the leading capital business in the world. And, obviously, I'm sure there was a great deal of learning and perspective that you took from it.
Yeah. No, I was very fortunate too. So I was over 25 years at GE, 10 years at GE Healthcare, and then 15 years at GE Capital, as you mentioned. And I worked in both of their commercial finance business, which was a business-to-business lending, for about 6 years. Then I was almost a decade in their consumer lending business. And in its heyday, meaning, through the 90s and then up until the financial crisis, GE Capital was just a global machine. They would buy a platform in any country around the world with a certain product set and then build other product sets around that. So, for example, when I was in the consumer business, they would buy a mortgage business. I'm just making this up, but this is the analogy. They'd buy a mortgage business in Australia. They'd buy an auto business in the UK, and then they buy a personal loan business in Switzerland. And then they would attach, so if they had a personal loan business in Switzerland, then they would attach mortgage and auto to those. And so they would build product franchises, and then either through M&A or through organic, eventually have full service consumer platforms at its peak pre-financial crisis, over 25 global platforms, country platforms around the world. So very business building, hyper growth focused, both M&A and organic. And that's an exciting time to be in a global business. And I lived and worked in 3 different countries. I lived in Australia, Switzerland, and the UK. And so got to see that and we contribute to that live. But they had a very structured playbook around how they invested in country platforms, how they did mergers, M&A add-ons, and then how they drove organic growth programs, particularly around new product introduction. So, as I said, it was exciting to be part of that. It flipped quickly in the financial crisis, and we went from being this massive global growth business to being a portfolio management and how do we structure runoff businesses and actually selling off assets. So I kind of got to see the run-up of that. I was there from the late 90s until the credit crisis, so I spent quite a exciting period, in hyper growth, and then my last couple of years at GE Capital actually unwinding that, as I said, divesting of assets and so on. So a lot of learning in there across the board.
I think when we work, I haven't worked for a business like that, but I've spoken to a lot of people who have in these big blue chip organizations. I think a lot of the learning points are sometimes taken for granted as you kind of reflect back on it and go, oh yeah, that did take a lot actually, but then it's kind of all normality now and it's been brought in. What's 1 or 2 things that you took from that you're like, if everybody could work in that environment, these guys just did this so well?
Yeah. I think 2 or 3 things. I think it didn't happen overnight, but the focus playbook around investing in businesses and having a 100-day plan. It doesn't have to be a 100-day plan, but just saying right away, they're going to put in either hire or put in a new CFO in a business, so they get the financials right, and those kinds of things, and how they're going to engage the teams culturally and bring them into the new family, which is now they're part of GE Capital. And in many cases, they would retain brands, and have. So it's not always they just obliterated everything they bought, but they would build on the local brands, but very quickly bring people into the GE Capital way and how things were done in an engaging way around talent development, and say, here, there's more opportunity for you as an individual in your career, in addition to being part of this global growth machine. So I think that playbook was important. I think just and then they had the benefit that they were investing at a time when global markets were growing, and this was in the late 90s, as I mentioned. So Eastern Europe was opening up, and and consumer banking was becoming available to consumers in many parts of the world where it had not been, versus the mature market. So they benefited from that dynamic, but capitalized on it, and had incentive programs and things where people could share the wealth and be part of that journey, and not only just from a skills and learning perspective, but also financially. And then I think the last thing, which was, like you mentioned, sometimes you don't realize it at the time, but you look back and say, wow, that was really special. They invested quite a bit in global networking. So all the senior managers, there are about 400 senior managers in the company across all these country platforms. They would bring them together every year to meet and greet, for 2 or 3 days. And so, yes, there was a meeting agenda, but it wasn't just playing fun. It was networking. So, when I ran the Australian business for 3 years, I'm an American running Australian business. I got to know the man or woman who is running the Irish business, or you go over the Spanish business, and then you would have that network throughout the year, and you knew you'd meet again a year later, and it built a tremendous camaraderie and sense of belonging to something bigger than yourself. And I think not every company has that capability, but you can bring that back down to smaller businesses and say, how do you create that same sense of engagement that we're doing something special here, and privileged to be part of it, and in addition to the learning, and the networking.
Not only am I the host of the Private Equity Podcast, but I'm also the founder and managing partner of Raw Selection. Raw Selection is a private equity specialist executive search firm with two divisions, one that focuses on portfolio, C-suite executive hires, and one that focuses on private equity direct hires via back office and investment deal professionals, operating across Europe and North America. A unique offering of our service is that we offer a full money-back guarantee on all upfront deposits. We typically take around $10,000 as an upfront deposit to commence a search process. The remainder is then on completion, but that upfront deposit is completely refundable. If you're not happy with our service, we'll refund that upfront deposit, no questions asked. Would you recommend, because this is something that I think portfolio or private equity firms should do with their portfolio companies, bringing their C-suite guys together, getting their CFOs together. It doesn't have to always be in person. A lot of that can be done virtually, as to share playbooks, share ideas. What's your take on that?
No, I think absolutely. As I mentioned, I've been in the last 9 years of private equity. I've seen a few PE firms do that, and some have done it well. And not, it's great that they even try to do that. I think many have not followed through. And I've sat in the chair twice in stepping in to run two private equity companies through exits. And so I know sitting in the CEO chair, you're always thirsty for networking with your peer group, whether that's other CEOs or if you're a sales leader or a PE firm, say, hey, what are the other firms doing? What are they learning? Not so much the industry experience, because that's specific to a company, but in terms of the more common issues around talent development, around market penetration, or just living in a PE world environment. But to your point, I think it is powerful. I think portfolio companies like that because it's an added value. I think the negative is that the PE firms, unlike maybe non-PE firms, public firms, sometimes their shorter term view doesn't. They don't see the value, or one, they may just not aware of that, or the second is they don't see the value of that in a 4 or 5 year hold period necessarily for an individual portfolio company, which isn't necessarily wrong, but I think there's intangible benefit there that maybe they're overlooking.
Okay. So what are your influences? What do you read? What do you watch? What do you listen to? Do you recommend that others check out?
Yeah, well, that's a pressure question because others check out. I've always liked variety. I joined GE to go and do a lot of different things, and I was the person who put up my hand and said, hey, I'll go there, I'll do this, I'll go to that country, and it had a family that was flexible around that. But that translates into my my personal interests. I'm still I'm later stage career, but still working and excited to contribute. And I like to be busy, so I think I read all kinds of stuff. I get different feeds, and I try to read and look at a diversity of things. And so that would, instead of recommending one specific thing, I'll look at Fast Company or Wired Magazine or Inc. Even though I'm not in a small business, that's a startup type business. I like to see, well, what are people in smaller businesses doing, or what are they facing? I've subscribed over the years to Franchising Magazine, even though I have no interest in being a franchisor, to say, well, what are the trends and what are people doing in terms of new businesses? Not so much, that I want to do a startup, but that's where you see a lot of incubation. And then I track a lot of the, more typical, Financial Times and Wall Street Journal and that kind of stuff as well. But I guess the key point is I've enjoyed personally having a diversity of interests. And I've always been a problem solver. And I think I get stimulated and encourage people to look at, read, experience multiple things that then may have a situational application somewhere else where you didn't think that it might, either around a specific problem or just in terms of general navigating stuff. As you get involved in any business, whether it's a private equity business or not, things come up, and having situational experience or reference points or ideas is often very helpful.
Perfect. And if anybody wishes to reach out to you post this podcast, Richard, how best do they get in touch, please?
Yeah, they're welcome to email me. I can read it off right now if you like. It's GB43NEFF, which is my last name. So GB43Neff at gmail.com. And always happy to hear from people if it's just general networking or, however I might be able to help someone.
Perfect. Well, thank you very much for coming on to the Private Equity Podcast, Richard, and sharing your insights and learnings over your career.
Yeah, no, thank you, Alex. Really enjoyed it.
And thank you very much to all our listeners. If you haven't already done so, please do subscribe to the podcast, which comes out every single week. But till the next time, keep smashing it, and thank you very much for listening.